Alright, so I wanted to make a very quick video on explaining why I made that new feature and also on the topic about liquidity and the order book that has come up quite a lot recently. And I wanted to just quickly explain what the order book is and what you will see in there and what you might want to pay attention to or just mentally keep in mind when you do that. And so this is Binance. It's not really the best visualization that is out there. It's very dark, but you kind of get the point. So what you see over here is there's 2 Bitcoin for sale at 88,100, 88,200 has about 190 Bitcoin for sale, and these are these aggregate levels. If you make it more granular, then you can see the very individual buy orders and where they are set at which prices. And this is why I made this visualization for you now from the conversations that we had before, because you can actually see how much any market order would move the price. Because say for example you wanted to buy 100 Bitcoin and you wanted to buy it at a good price. Right now it's trading at 88,200 more or less. But if you wanted to buy 100 Bitcoin, you would have to buy everything here, everything here, everything here, everything here, everything here, everything here, everything here. And your price, average price would be somewhere around 88,300. So like $100 more. If you wanted to buy 1,000 Bitcoin or 10,000 Bitcoin, then your average price, as you can see, would probably be like 1,000 or 2,000 or 3,000 higher, because especially since October 10, the order book has been really thin and all of the liquidity has been taken out. So what does the market do? Market makers and exchanges alike, they hunt for liquidity, and usually these are very high leverage positions. So you don't really want to see the Garrett Gins at 5x because they don't really matter. The liquidation is so far. But you care about the 100x and 50x and 40x long and short liquidations because they are very close. In addition to that, you care about the stop losses. So where are the most buy orders? You would probably think that they're somewhere below here, but they're really not, because we can go on the whale watch and you can see that there is a lot of shorts that are somewhere around the 95, 96, 93,000 area, and their stop loss is very likely around the previous high, and they just entered, right? So where do you place your stop loss is you enter here, you would think something goes down, most bots do the same, and you place it probably somewhere near the previous high. So what does the market do? It tries to take this liquidity up here, because someone wanted to buy and sell a large amount of Bitcoin. Where do they do that? If they wanted to do it in a short time frame, it would be here. And very similar, if you look at the previous lows, it will likely have a lot of stop loss orders around here. And with the longs, it's actually very bad because we have a lot of very high leverage longs. So there's also a lot of liquidations that were happening here, which you can see on the liquidation map that I shared a couple of times, and also on Wenger. But there's of course other ones that have similar ones. I just wanted to point out that the one on Wenger is actually real. And orders also pile up here, because every time the market moves down to some range and then breaks out, there's a lot of leftover buy orders. Why? Because everyone thought here that maybe they can buy a little bit lower, or when the price was entering here, it moved up a lot, they will place their buy orders a little bit lower. Especially retail traders are like this, and all of the orders will pile up here and never get filled, and few people actually cancel those orders. So around here you get a lot of liquidity that is unfilled by orders as well. So the market does what the market does. It tries to fill those orders within immediate vicinity, and that goes on every type of time frame. Of course, also on the shorter time frame that you can see. So often when you see a wick, you see the price come back there because it just represents a lot of unfilled buy orders. Now you have this new visualization on analysis order book, which I made, and you can see exactly on every type of exchange where there is more liquidity and where there's less, and why some whales might want to trade and where you have the manipulation going. And if you wanted to find out how someone would manipulate the price, that's something that I'll cover in another topic. In essence, with liquidity that is this low or lower, it's very easy. You buy and sell to yourself at slightly higher prices, going on and on. Move the price up until you hit some stop losses or buy losses. And market makers and exchanges, instead of just buying and selling to themselves, they fill the spread along the way. That's why I say that the liquidity that is very close is much more important than the liquidity that is very far.